Bank collapses. Are they going to happen again? In my humble opinion, yes they are. And last year's Silicon Valley Bank and Signature Bank collapses will make this look like child's play. In this video, we're going to give you a reason why that's happening, what that means, and potentially what you can do to cover yourself in the event of these situations occurring. So let's take ourselves back throughout history. Typically, a bank with the fractional reserve banking system had to keep at least 10% as a reserve requirement. So every $100 you put in the bank could lend out 90 of it, they needed to keep 10. But in March 2020, the US government placed a rule in place where the reserve requirement went to zero. Basically meaning they could lend out the entire amount of money on any deposit that came in. Now, it solved a problem at the time, but like anything, you're just patching over the problem, which at a later date is going to cause more problems. And that is what's happening now. You saw a bit of it last year in 2023, and now in 2024, we're going to see more of it. In fact, in November of last year, the CEOs of three largest banks in the United States, the Bank of America, JP Morgan, and Wells Fargo, told Congress that we can't even increase our reserve requirement to 3%. Okay, that's the biggest banks. But you've got hundreds of smaller regional banks in the United States. Now, the argument is here, these three big players in the market that can't hold up that can't even increase to a 3% reserve requirement, they want these banks to fail because they want the banks to fail so they can buy them up for pennies on the dollar and take their customer base. Essentially, what you're going to see is what already happened more in Europe and the UK in the last financial crisis, where the banks were brought into you went from 10 banks to 4 banks. Well, in the United States, you've got hundreds of regional banks. They're going to get eaten up into this system. Also, these regional banks don't necessarily have the structure in place to meet the Basel III requirements, which they're going to need to keep their bank sustainable. Now, how's this going to affect you? Well, what you've got to look at is from the upcoming month ahead, from the 11th of March onwards, the banks won't have enough money to be able to lend out. So at that point, the Federal Reserve is going to come in and say, well, we're going to tell you which banks can lend out, who you can lend out to, and who you can't lend out to. That's obviously going to put extra pressure on these smaller banks because they're reliant on lending money out, money that doesn't exist, because we use this ridiculous system called fractional reserve banking, where basically they don't have the money and you as a consumer are the one that's getting robbed for that money. But if they can't lend out, they can't make any more money. If they can't make any more money, they can't keep their reserve requirements up. They go under. Now, what you need to understand here is what's going to happen if these banks go under. Now, you saw last year the FDIC came in and bailed out for these specific banks to make sure everyone was protected. Oh, great. Okay, they protect you up to $250,000. Super. So for Silicon Valley Bank, Signature Bank, the contagion was stopped quickly, and the effect on the consumer banking was not as much as what it could have been. But now what you need to understand is this contagion is going to exacerbate over the forthcoming weeks, and because of a rule that was put in place in 2010 by the US government after the global financial crisis, which basically said, we're not going to bail you out anymore. Okay, great, that's awesome, because the banks should have been bailed out in the first place. Why should they get bailed out when they're actually just printing money out of thin air? But the problem is, they opened up a Reform Act, which means they can have bail-ins. You need to understand what bail-ins are. Bail-ins are basically like, okay, you don't have the money, we're going to take it from you, Mr. Consumer. So if you've got deposits in the bank and the bank can't meet its requirements, they're going to take your money. If you've got pensions sat there, in the United States, you would have 401ks. If they can't meet the requirements, they're going to take your money. So anyone with a ton of money sat in these bank accounts now, particularly in the United States, where you've got these smaller banks, you are massively, massively in a bad place, in my humble opinion. Based on the information that's available out there, you have to dig around because they don't necessarily want the general public knowing this. So what can you do? Well, you need to understand what's happening next. And as we see the collapse of these banks, we're seeing the collapse of the existing fiat financial system. It's coming to an end. If you don't understand fiat financial system, we'll do a video in more depth about it. But essentially, fiat financial system means it's backed against nothing, it's out of thin air, and the US has printed and printed and printed and printed, and now they can't pay the debt back. You're seeing the system, all the issues with the system coming to a front, and that means now we're going to be looking at moving into a different world currency, an asset-backed currency, or asset-backed currencies. Maybe it won't just be a US currency, it'll be multiple currencies. You've got to look at the BRICS. We are moving into a multipolar world, and as we moved into a multipolar world, there's going to be lots of these asset-backed currencies coming into play. Every country has a certain different assets. You can see as well, and it's key to understand, look at not what they tell you, look at what they do. The central banks are buying up thousands of tons of gold. Why? Why do they need thousands of tons of gold? Well, it's quite obvious why they need thousands of tons of gold, because we're going to move to an asset-backed currency. You're also looking at the opportunities with gold, and in particular silver, which I'll explain to you in a second. Is gold and silver have been completely undervalued. The price has been suppressed for 50 years. Why? Because they didn't want gold and silver around. There was no requirement, no need for it. So the price of gold and silver is completely suppressed. If people start buying up gold and we go to asset-backed currencies, what do you think is going to happen to those particular assets? And also, if you're holding those assets, it's not that fiat paper money which is going to become worthless, in my humble opinion. I think also you've got to look at the opportunity in silver, because the price of silver in comparison to gold is astronomically smaller than in comparison in history when currencies were backed against gold. When we didn't have a fiat currency, the price of silver and gold were much more evenly matched, whereas at the moment, the price of an ounce of silver is next to nothing in comparison to the price of an ounce of gold. You've also, as we always talk about on this channel, in particular, and my great belief is understanding if we do move into these asset-backed currencies and we are moving into a tokenized environment, you're going to need a bridge currency in between each of those. So you're going to see the end of this fiat system moving to asset-backed currencies, and you're going with the element on top of that of digitalization, tokenization of assets, and you're going to need a bridge currency to move in between the two. I would love to know your thoughts in the comments though. I hope this helps.